Hey everyone, Alan Perez here, and thank you guys so much for tuning into my portion of the mid-year review for A1 Trading. It is my pleasure to talk to you guys. For those that didn't get to watch the stream or that are just going to review the recorded version, I was not able to make it on there for a scheduling conflict, but this is my mid-year review from a currency trader's perspective. I trade mostly currencies. I look at all markets though, as they drive my decision-making skills. And we had a really crazy year so far, right? We had a very volatile environment. There's been lots of shifts back and forth from risk on to risk off. And I'd like to go over what worked before, what works now, how I'm operating in this environment. I'd also like to give you some key takeaways to help you maybe better survive this current environment that we're in. So we'll get started here. So the year so far, right? In the beginning of the year, we had the initial Trump trade, right? The Trump trade plus the Trump tariffs. Initially, it was between U.S., Canada, and Mexico, China as well. And that, whenever that, kind of headline news was given into the market, whenever we heard that, the dollar really appreciated pretty fast, right? And then the kind of sentiment shifted as the tariffs became from being very isolated to a certain region of the world. Now we started going. The U.S. started to attack very other countries. 50% reciprocal tariffs. We all remember that April 2nd announcement that caused a global panic, right? And that's when we saw those inflows from risk on assets to the safe haven assets that we all saw. And so that was a really pivotal moment, right? And from the beginning of the year, we had lots of volatility. Whenever tariffs were mentioned, we saw big moves in the market. I remember specifically dollar Canadian was one that I was buying in the early part of the year, and I'd be folding laundry or doing whatever I was doing. And I remember specifically that the trade will jump up 150 pips in like an hour, and then within the next few hours it'll be retraced already 50% of that move. And it was a very whipsaw kind of price action that we saw in the beginning of the year, and it kind of never went away, right? As we kind of transition into from isolated tariffs to more of a global tariff situation, that caused a lot of volatility. And what worked before, right, in that environment, or before that, very vanilla directional swing trades is basically what I do. That worked pretty well, right? Trends were reliable. There wasn't that much of a noise, right? Whenever we as traders, we have to kind of anticipate and trade along with noise, right? Every now and then, whether it be an NFP event or just something very volatile that happens, you want to be able to make a trade, place it, and absorb that move, right? And whenever this new environment kind of came into play, that risk that we had really got amplified, right? So what worked before was just directional FX plays, swing trades. You were able to use your narrow stops, or narrow is relative to the person or the individual, but narrow stops, you could position maybe a little bit bigger, right? Because the price action was a little bit more, not predictable, but more manageable. And so what happened, right, whenever we saw those price actions, immediately, luckily I was on the right side of the move, right? When I was in dollar Canadian, it would appreciate 150 pips really fast. And I was on the right side of that. But in my mind, I was cautious and considered that, like, what if I was on the wrong side of that, right? Trading, especially when leverage is involved, it's a double-edged sword. So immediately I said, look, if this is going to continue, which in the moment, and if you kind of look in hindsight, it has, right? But I told myself, if I want to survive this market, right, what if I was on the wrong side of the trade? So I had to, one, widen my stop, and had to reduce my trade size, right? Because if I'm placing a trade, the stop needs to be where the stop needs to be. And with this increased volatility, the ATRs, the average true range for certain currency pairs, let's say a pair had an ATR of 50 pips. Well, now it was more like 100 pips or 75 pips. So you have to widen that stop loss and your profit targets to kind of survive the trade, right? To account for all this extra noise that we're experiencing. And also, these moves happen really fast. A trade that I would target 100 pips that would used to take 3, 4, 5 days, maybe a week, is now happening in an overnight session. If we're just remembering the dollar Canadian, right? That the 150 pip move happened in an hour. And so my time horizon and my expectations for trades got smaller as well. So wider stops, lower position sizes, and my time horizon for the trades also narrowed down. And so that's pretty much how I tailored my strategy. I still used technicals and my fundamentals to kind of get a gauge of narrowing down and kind of just selecting which currency pair I'm going to trade and which one's in play, right? If we remember just the beginning of the year, I always reference dollar Canadian. I don't trade dollar Mexican, but those were very isolated, polarizing sentiments for those three countries, Canada, Mexico, and China. So I use my fundamentals and technicals to kind of get my entries and to account for my stop losses in that. But I also really shifted a lot into sentiment, right? The market was very, very headline news driven. And so whenever you want to place a trade, if you can find sentiment, polarizing sentiment also as another confluence, that will really propel your trade. And you'll know pretty fast if you're wrong or right? And so whenever we went into this global tariff situation, April 2nd, right, that was a big, big move from risk on to risk off. And that's why we saw those yen flows, those Swiss franc flows, those gold flows. And so those are pretty much how I pinpointed the best trade possible to take. And so, I adapted to the news cycle. I was always having my financial juice up, and I was able to see, right, if I'm always looking at my news terminal to see what's going on, you can get a gauge after some screen time. Once a certain catalyst will get hit over and over and over, it'll react. And then you see over time that news catalyst will hit, and then the market won't react that much. And so that was kind of my edge, is like I was able to look at it, monitor everything, and see in real time the market's actually not starting to care about this anymore. And so you can kind of pivot and stop trading certain things or trade certain things now that you know that markets are caring more about certain things. So that is pretty much how I tailored my strategy. Was I put a little bit more of an emphasis on sentiment analysis. And some of the best plays for the year, you could say it was, right, if you reference the VIX, the put to call ratio, when the VIX started to fade after we got into the 60s, when the put to call ratio was getting really extreme, the best trades, the best opportunities were when sentiment was at a very big extreme. And so it's always really, really good to go ahead and use those tools. And, luckily as traders, we have those tools available to us, whether it be looking at the VIX chart or looking at the Edge Finder's put to call ratio. They even have a risk on, risk off gauge built into the Edge Finder. So we have the tools available for us to go ahead and monitor those assets or monitor those plays and be on the right side. So I'm going to give you a little bit of an example of one of the trades that I took, right? So this is the dollar yen, right? We were in an uptrend here. This is a 1 hour time frame or 4 hour time frame. It's a 1 hour time frame. Uptrend here, and right at this level here, this big blue line where my cursor is at, this is the April 2nd tariffs. So for all of this, we kind of had this tariff thing in mind. And on a technical level, right, we broke this trend line. We had some follow through. We stayed below it. And so that was basis for me to get in the trade. Now, I know that the yen is a safe haven, similar to the Swiss. And so this was my preferred, vehicle to trade this. I knew that come April 2nd, that was going to be the big day. The whole market was anticipating it. And if we were to get something worse than the 10%, the market would have sold off. We would have saw those flows. So I was in the trade. I was in profit, then flat. And for the most part, I was flat for a little bit. And then the news came for April 2nd. And the Trump administration, or Trump himself, went ahead and said, we're going to target or give everyone a 50% reciprocal tariff. And the market really saw those flows. Now, one mistake that I did was I forgot to move my take profit level because I wasn't expecting such a continuation in the move. So I got taken out early. But that is a good example of using technical analysis, fundamentals, right? Fundamentally, we could expect that to happen, and then pinpointing the exact best currency to trade, whether it be the US dollar yen or the US dollar Swiss, because we know that if the worst case scenario happened, those, that global fear is going to trigger that safe haven demand. And that's what happened, right? And when we saw a lot of that and I've been using that ever since for the whole year.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.